So let us begin from where we had left. The third type of cognitive bias that we are going to talk about is called as loss aversion. What is it? It is the pain of losing is more powerful than the pleasure of gaining. This is what is called as loss aversion. Let us try and understand it with an example. Let us say that you have invested an equal amount in two different stocks, A and B, $1,000 in each. What happens? In 1 year, the company A, your $1,000 become $3,000 in 2 years, and in B, your $1,000 becomes 600 in 2 years. So what happens? The first one has given you a profit. The second one has given you a loss of $400. Now this loss of $400 is giving you more pain than the pleasure which you are supposed to get from this gain of $2,000. That is how life is. Not with you or me, with everyone this happens, and that is called as loss aversion. We are not willing to accept losses. So what we do now, because we are inflicted by this cognitive bias, what we do, we will sell off the company A's stock, thinking that it has already grown too much, it may not go higher, and that money what we get from here, we reinvest that in the loss making one, thinking that it has gone down, now it will catch up and I will make big money. We are basing our financial decisions on this cognitive bias, not on facts and figures, not on our knowledge or on our professional acumen. See how we go wrong at times. And then we find that in another 1 year, A grows further by 30% and B further declines by 30%. Why has this happened? Because we had not seen the financial statements, we had not seen the facts and figures. We based our judgment, we based our decision based on the cognitive bias or loss aversion. So be very careful of this bias. If you are a consultant or a financial advisor, then you would often find clients who become jittery seeing the notional losses on the screen. They would urge you to keep churning their portfolio, but then you have to understand the psyche of those people. You have to understand that they may be having some loss aversion, but you can't tell them on their face, you can't be blunt and tell them that they are having this cognitive bias. If you do that, they may get annoyed, they may not take your advice. So use all your knowledge of behavioral finance and in an appropriate manner try to give them proper advice. All right. The fourth type of cognitive bias is overconfidence, and this is one of the most dangerous cognitive bias. What is it? See, in this we we try to overestimate our knowledge, our predictive ability, and our control over outcomes. This is what we try to do when we are successful. Too much of success brings overconfidence bias. Let us say that you or me, whatever, we are a professional options trader, an options seller, and you know that option selling carries huge financial risk. But you are a good or you are a professional options trader. You have very good knowledge of your field and you are a successful person. All right. And the risk management says that you must hedge your position. Whenever you are taking a position in options, you must hedge it. But hedging eats away a portion of your profit. We all know that. Your last 10 trades were hugely profitable. All the 10 trades were successful, but they were hedged positions. And in hedging, you had to give up some of your profit, which became very painful to you. But because of repeated success, you became overconfident. You became inflicted by this bias called overconfidence. And the 11th trade that you took a big trade without a hedge, thinking that now you are an expert, you cannot go wrong. And what happens? Luck goes against you. the 11th trade goes wrong. Something like 9/11 or COVID pandemic happens, and you lose more than what you had gained in the previous 10 trades. What had happened? You ignored the basic principle of finance. What caused you to ignore this principle of risk management? This overconfidence bias caused you to do that. You did not follow the principles of finance which you had studied. The fifth type of cognitive bias is called as the bandwagon effect or the herd behavior. All right. Now, what happens, when things are not clear, we just follow others. We start doing what others are doing. Nothing can be a bigger myth or a bigger ill advised than this. When things are hazy, rather than removing the haze from their eyes, people tend to follow others without realizing that others may be heading straight into a deep well. Without realizing that, we just try and follow the masses, what others are doing. If the stock market is in a boom, people feel left out and they start selling their assets to invest in stocks just because everyone else is doing it. And similarly, when the stock markets crash, people feel they are doomed and they start selling all their assets or all their stocks at a loss. Why? Just because everyone else is doing it. Now you see, people may have developed this cognitive bias. People means it includes you and me. We are not different from everyone. All right. We may have grown up, in such circumstances. We were told as we grew up, we may have been told not to be an odd man out. Don't defy the society. Do as others are doing it. Don't go against the tide. That is what we have been taught since the childhood. So even as professionals, even as experts, if we start believing in that, then of course we will be doomed. So therefore, whether it is your own money or whether you are advising others, just pause for a moment and think, are you the shepherd or are you the sheep? Are you going to lead the way or are you going to blindly follow? All right. So before following others, look at the facts and figures and then decide whether what others are doing is a right thing or are they just jumping into a well. All right. So some more cognitive biases we may see in the next lesson. I hope you are finding it interesting and you are enjoying it. And I also hope that it is adding to your knowledge of behavioral finance. All right.